Today, we're diving into a term you hear all the time, a number that seems to dictate the mood on Wall Street every single day, the Dow. You know the drill. You turn on the news, and there it is. The Dow is up 200 points, or the Dow plunges. It's just part of our daily lives, like a shorthand for the economy itself. But let's be honest, what are we really talking about when we talk about the Dow? All right, so here's the game plan. We're going to start with what the Dow actually is. Then we'll get into its kind of weird calculation method. We'll look at the 30 companies that make up its exclusive club, take a ride through its wild history, put it head-to-head with the S&P 500, and then figure out why this old-school index still gets so much airtime. So, first things first. What is the Dow? Well, you can think of it as the economy's oldest and, for sure, its most famous temperature check. Okay, so its full name is the Dow Jones Industrial Average, or DJIA for short. At its core, it's a stock market index that just keeps an eye on 30 of the biggest, most established blue-chip companies in the U.S. For more than 100 years, people have used it as a quick snapshot of how the U.S. economy is doing. The basic idea is if the Dow is strong, the economy is strong. And its roots go way, way back. We're talking 1896. Two guys, Charles Dow and Edward Jones, yep, the founders of the Wall Street Journal, needed a simple way to track the pulse of America's exploding industrial economy. And so the Dow was born. So, how is this thing actually calculated? This is where the Dow gets a little unique, and it all boils down to its secret sauce, a method they call price weighting. And this is maybe the most important thing to understand about the Dow. It's price weighted. Now, what does that mean? It means the Dow gives more influence to companies that have a higher stock price per share. It doesn't matter how big the company actually is, its total value. All that matters is the price of a single share. This system leads to a really quirky result. Check out this quote. A $1 move in any of the 30 stocks has the exact same impact on the Dow's final number. So a small company's stock going up by $1 moves the needle just as much as a massive company's stock going up by $1. Kind of weird, right? So you might be wondering, well, what happens when a company splits its stock or a new company gets added? Great question. That's where something called the Dow divisor comes in. It's a special number that they use to divide the sum of the 30 stock prices, and they're constantly tweaking it to make sure that a simple stock split doesn't send the Dow crashing and give everyone a heart attack. Okay, so who are these 30 companies anyway? Let's peek inside the Dow's very exclusive and constantly changing VIP club. I mean, this table says it all, doesn't it? Back in 1896, you had these industrial giants like American Cotton Oil and U.S. Leather. Fast forward to today, and who do you see? Tech titans like Apple, Amazon, and Microsoft. This list right here is basically the story of the American economy's transformation from industry to technology. And here's a perfect visual of that price weighting thing in action. Just 5 companies, because their share prices are so high, make up almost a third of the Dow's entire value. It's a pretty powerful reminder of how just a handful of stocks can really steer the whole index on any given day. You know, when you've been around for over 125 years, you're gonna see some things. The Dow has had a front row seat to some of the biggest dramas in economic history. It has been one heck of a roller coaster. And what a ride it's been. It started out at just $40.94. During the Great Depression, it was almost completely wiped out, losing nearly 90% of its value. It had its worst single day ever on Black Monday in 1987, dropping over 22%. It got sliced in half during the 2008 financial crisis. And yet, through all of that, it has climbed and climbed, recently breaking 40,000 for the very first time. In fact, get this, to really put its journey in perspective, during a panic in 1896, right after it was created, the Dow hit its all-time low. That number was just 28.48. It's just an incredible testament to both the volatility and the long-term growth of the market. But for all its history, not everyone is a fan. Many experts don't think the Dow is the best way to measure the market. And that brings us to the big debate. The Dow versus its younger but much bigger rival, the S&P 500. Okay, so here are the differences in a nutshell. The Dow is that small, exclusive club of 30 stocks, and it's price-weighted. The S&P 500 is a much bigger party, with over 500 companies. But, and this is crucial, it's market cap weighted. That means the companies with the biggest total value, think Apple, Microsoft, have the biggest influence. Because of that, most people agree the S&P 500 is a broader, more accurate picture of the US stock market. And yeah, because of these differences, the Dow gets a lot of heat. Critics say, look, 30 stocks is just too small a sample size to represent the whole economy. That price weighting method can give you a distorted picture. Plus, the way companies are picked for the Dow can seem a little random compared to the strict rules other indexes follow. So, if it's so flawed, why do we still talk about it so much? Why does the Dow still matter? Well, the answer is, it's an icon, but an icon that comes with a pretty big but. Its real power today comes from its history and its fame. Let's face it, it is, without a doubt, the most quoted market indicator in the world. For millions and millions of people, the Dow is the stock market. Its ups and downs literally shape how the public feels about the economy. And here's the real kicker. For all its weird quirks, over the long haul, its performance tracks very, very closely with the S&P 500. More often than not, when one goes up, the other goes up. They pretty much tell the same story. So yeah, it might be a flawed messenger, but it usually gets the message right. So let's just boil it all down. What are the key things to remember? 1. The Dow is a quick but incomplete snapshot of the economy. 2. It's price-weighted, which means a $1 change in any stock has the same impact. 3. Its members have changed dramatically, telling the story of the U.S. economy. And 4. It's a powerful symbol, but most experts will tell you the S&P 500 gives you a better picture. And that leaves us with one last big question to chew on. In an economy where a handful of truly massive tech companies have so much power, can an index that's based on share price and not the actual size of a company really stay our most famous economic benchmark? For now, at least, it does. Thanks for tuning in.